Great, welcome. It's great to be here. Within KKR, so I started my career, I spent 13 or 14 years at Morgan Stanley, and then I transferred to KKR. This is a model that we developed back at Morgan Stanley, and it looks at where we are in the cycle. Red is recession, green is recovery, blue is kind of things are okay. We've actually been in a what we would say is a contraction / slowdown period for almost 2 years. What's different is most investors are used to this and this, where you had big drops. This is probably the slowdown we're seeing right now is probably much more akin to 2001, where unemployment doesn't go up as much. And when you look at our indicator, it's actually starting to gain momentum to be a little more positive. And this is the indicator. There are 10 different inputs in the indicator. 2022, it was telling you to be very cautious. That's where we were. Now, it's actually about to go from contraction into early cycle. What's interesting to me from a bigger picture standpoint, was referenced by the prior speaker from KIC, is that this is a very unstable time where when I started at Morgan Stanley, all 10 of the inputs would be in one quadrant. The US would buy, China and Asia would sell, Europe would participate, and we would have a global synchronized recovery. That's not happening anymore. If you look at the inputs, they're all over. They're in contraction, early cycle, mid-cycle. So we're constantly in this world of kind of rolling recovery and rolling recession. The other big thing, and I'm not going to go through every single point on the slide, is everything that I learned. I went to Wharton for business school, the University of Virginia for undergrad. All the things that we learned in financial theory and economic theory about what should happen, the exact opposite is happening this time. We've had an inverted yield curve for 14 months, no recession. China is going through deflation. Japan's going through inflation, right? The Japanese yen and the US Treasury, they used to rally during periods of fear. They're now selling off. So almost every traditional kind of macroeconomic indicator that we were taught to invest, it's actually not working. And so you have to have this whole idea of thinking through a different lens about how you invest and a whole new, what we call this regime change, right? And so that's what we've been doing at KKR, is to think about the world a little bit differently. Point number 3 is really important. Most big downturns globally were caused by the corporations or they were caused by consumers. Right now, most of the debt that's been created since COVID, it's been in the government sector, right? So one of the things that we've been trying to do is avoid owning as much government bonds, but focusing other areas in the market where there's not as much supply. So this is probably the most important chart in the whole presentation, so stick with me. We were living in a world here of low growth and low inflation. And we had tight fiscal, loose monetary. And central banks could not hit their inflation targets. So they did quantitative easing, which really accelerated after the great financial crisis. Along comes COVID, and again, here's our premise. More fiscal stimulus, more geopolitics, messy energy transition, and then more demographic challenges around labor. It moves us up here to higher growth or lower growth, but higher inflation. That's the regime change. So KKR is going to do fine for its investors as long as we don't go back to tight fiscal, loose monetary, low inflation. We're somewhere in the upper quadrants there. The yellow line is the rate of inflation. What's happened is the purple bars. The relationship between stocks and bonds used to be negative. So you could own lots of stocks and then you could diversify your risk by owning bonds, okay? That's no longer working. That is a huge deal for anybody who allocates assets. They've actually become positively correlated, even though inflation has come down. So the fundamental premise of a 60-40 or a 70-30, 60% equities, 40% bonds, that's not providing as much diversification. So what's happening is the volatility of portfolios is going way up But it's not going up because of single asset risk. This is a huge, in 2008, you had single asset risk as banks delevered. This is a fundamental reshaping of the capital markets driven by, in my view, too much government debt and a changing relationship between stocks and bonds. If I'm right, anybody that allocates assets globally has to rethink about how they've thought about the world. So that's the premise of what we're saying. So this is our inflation model internally at KKR. What you can see is that it comes down. Remember, the Fed's target is 2%, but it doesn't get to 2%. And really what's driving it is the stickiness around shelter inflation, medical inflation, healthcare inflation. And so you see that on the right-hand side between the services, which is the bars that are barely moving, and the goods inflation, right? Goods inflation has generally been around 0 to 1%. But services inflation, which embeds wages, is still sticky. And that's where you've had a lack of supply of housing, right? You've seen insurers raise prices around healthcare premiums, as well as around other auto insurance, other than those. And so it's taken much longer to get to the Fed's neutral rate. And so our premise in this world is that we want to own more of nominal GDP, not financial GDP. So we've increased our allocations to things such as infrastructure. And so that's what we've ended up with is this is the difference between tight fiscal and tight monetary. And what's happened is most everybody in the room that grew up as an investor, you invested in a world of loose monetary and tight fiscal. And now we're in a world of loose fiscal and tighter monetary. And you see this in terms of what's happening to growth in the world. This is an amazing chart. China's growth rate on a nominal basis, which is real GDP plus inflation, has actually dropped from 15% to 6%. That's a huge decline. Companies make their revenues in nominal, right? And at the same time, Europe, Japan, and the US have all actually seen an increase in their nominal GDP. And it's one of the reasons that there have been lots of people who've been very bearish on growth, but you got to think about it in real terms. So the disappointing side has been that China has not grown as fast as people thought, but at the same time, other parts of the world have participated. And so when we get to our expected returns at KKR, what are we saying here? You've had incredible performance from the S&P, and you've had really good performance from private equity. Overall, we're talking about flatter expected returns, which is there's more balance. You can make money in cash. You can make money in bonds. The last 10 years, because of quantitative easing, you wanted to extend the duration of your portfolio. You wanted to buy long duration equities that had big terminal values, venture capital, growth equities, right? Same thing on fixed income. You wanted to own long duration government bonds. You wanted to own long duration investment grade debt. In the world that we're describing, this regime change, you have lower overall returns, but you have flatter returns across the different asset classes. So I'm going to run through the different economic environments. This is the US. When I started at KKR, the government was a 40% drag on US GDP because we were being fiscally disciplined. Today, we estimate the government is a 50 basis point addition to GDP. Then Inflation Reduction Act, the Infrastructure Act, COVID handouts, all that has led to faster growth, but a lot of it has been driven by the government. So over the 10 to 15 years I've been at KKR, a very fundamental shift. Now, I mentioned earlier, you have the corporations, you have the individuals, and you have the government. If you look at the individuals, going into 2007, 29% of them in the US had variable mortgages. Today, that's 3%. So as the Fed has raised rates, you haven't had the same impact in terms of the monetary impact on overall consumers. At the same time, the US now has a pretty substantial debt load, and they haven't termed out their debt as much. And so think about this. The US federal government is going to pay $500 billion in interest this year. Our total national defense spending, $496 billion. Our total Medicare spending this year, just under $500 billion. So I don't think it's going to be a consumer recession that ruins the U.S. economy. The second thing, and you'll hear more from my colleague next on this, but I don't think monetary policy is actually that restrictive. One is I think productivity is enhanced. The second is on a real basis, we're only getting to about 2% real rates. That's not, in the past, we had much higher real rates. And that's really what the chart on the left shows you, which is we were at incredibly accommodative rates. And as the Fed is neutralized, we're moving towards a period where real rates are becoming positive, but they're not, we can debate whether they're restrictive, but they're certainly not. I think the historical average was around 3% real rates. The second big point is here on the balance sheet. If you look at the G4, right, the four big central banks, we're talking about their holdings going back to about 38% of collective GDP, which is about where we were in 2019. Relative to history, that's not that extreme. So certainly, I think the Fed is doing a good job of trying to slow the economy. The question is at the end of the day, is this restrictive? Given what we're seeing on productivity and corporate earnings growth, I'm not surprised that the markets have performed the way they did, particularly given what I said earlier. It's not just fundamentals, it's technicals. There's no net debt issuance right now besides government debt on the corporate side. And when you look at buybacks, the S&P is buying back $1 trillion per year. $1 trillion. Europe, I'll move through pretty quickly. The only thing I would say is when we had the crisis in 2011 in Europe, Germany and the UK were the stalwarts. And it was Greece and Spain and Portugal that were in trouble. If anybody happened to go there on vacation this summer, you will see that there are a lot of tourists in those countries. What's happening now is the periphery is quickly outgrowing the core. Of all the countries, I'm headed to Madrid and Paris the rest of the week, but of all the European countries I've been to, the one that is having the toughest time right now is actually Germany, right? Because you got hit by natural gas in Russia, and you've had a slowdown in China. The good news is, and I was just in the UK a couple weeks ago, is we are seeing economic surprises in Europe pick up off a very low base, but the story is getting better. And you're also likely to see some easing. I'm going to spend a second on China. China is about 25% of global growth, so you have to pay attention to it. I've been going to China since 1995. I took a lot of the banks public when I was at Morgan Stanley in the early 2000s. Today's China is dramatically different than what we used to see. Think about this. Digitalization, industrial digitalization is about 10% of China's economy, yet it's representing 3% of their 5% growth. Massive, massive investment by the government there. The second, which you read about in the paper, is around the green transition, which is really, think about EVs and other types, solar panels, all that. That's what's driving their growth. China used to be all exports, and then they were and fixed investment, and they were trying to create consumption. That's not where they ended up with their model. You see in the red here is the real estate. We estimate they have about 30 million too many homes in China, and that will continue to be a drag on the economy for some time. The only other point I'd make on China is China likely will have a pretty notable bout of disinflation, right? Inflation in the rest of the world has been high. In China, it's gone low. So let's tie this into how do we invest behind these themes given that backdrop? First is, my premise would be is that the bear market actually ended in 2022. When the US stock market goes down 25% or more, which is what it did in the fall of 2022, when you look at it on a 1, 3, and 5-year basis, you actually outperform. And so there's been a lot of conversations from different people on the market. Do you buy? Do you sell? Our view at KKR, most of our investments are 5 to 10 years, is we wanted to be buying. And so we've been deploying pretty aggressively, particularly around private equity. The second point is this. This purple line here, this is IPOs, levered loans, and high yield issuance, which we call capital markets activity, is a percentage of GDP. Today, it's at the lowest level since 2008. there's no net supply. So if you're running a fixed income product right now, you have to go into the market and buy because almost all the activity is refinancings. Typically, when you have a problem, it's because excess issuance. There's one asset class right now that has a lot of excess issuance. Any guesses? The US Treasury, right? Right there. Look at that. That's where you have the extreme. And that's why we're more cautious on that risk-free rate. Many different investors are focused on AI, and they're talking about NVIDIA and the semiconductor success that they've had. That's absolutely probably true. We don't have a large view on that at KKR. That's not what we do. Where we have been focused on is this idea of demand for energy accelerating at a time when the supply is not there. There's huge demand for electrification. You're going from, in Europe and the US, you're going from zero growth over the last 5 years to probably 2 or 3% growth. The majority of that has been driven by the data center usage. And again, there are two issues. One is there's not enough power generation. The second is the power generation is not in the right spots. Let's take Europe as an example. You've got hydro, wind, offshore. It's not connected to the grid. So this is something that we're all going to have to deal with. It makes me a little more nervous about electricity prices as I think about inflation. And then the second thing I would say is just bigger picture. What's going on? Remember in 2001 when you had the bond market crisis, it was on the internet. If you build it, they'll come around telecom. These were highly levered companies that were investing in CapEx, and when the capital markets shut off, they couldn't survive. Who's spending all this money right now? Microsoft, Google, Apple, Meta. They have fortress balance sheets. They have no net debt. Right now, they're spending, this year we think they'll spend $400 billion on tech AI out of a $2 trillion budget in all of America's AI budget, all of America's tech budget. It's a massive number. The chances of that slowing in the near term, I think, are very, very limited. The other point is, if you think about KKR, we own kind of 150 companies around the world. After COVID, employees started leaving the workforce at a rapid clip, particularly 55 and older. So we spent a lot of time focused on productivity. How do we create industrial automation and enhancements? Typically, when wages go up, what you see a couple years later is corporates are forced to invest on productivity. It's exactly what we've been doing across all our different sectors: healthcare, industrials, consumer. And so that's led to, as you can see here, we're starting to see some incremental improvement in productivity. But from an investment theme, whether it's Korea, Japan, Germany, US, we have a demographic challenge going forward that we didn't have in the past. And we've got to make some of that up in productivity. So that remains a major theme in which we're investing behind across KKR. The last one is just what I call the security of everything. This was referenced earlier. It's not Russia, Ukraine. It's not Israel, Gaza. It's not China, US. General Petraeus works at KKR, and he termed this phrase, we're moving from one benign globalization to one of great power competition, right? Everywhere I travel around the world, whether it's India, Japan, people are trying to keep their flows more internal. Right? What did Macron just say in France? He said, why should France be subsidizing the US deficit? So you're getting these trade barriers, you're getting a very different supply chain. And so cybersecurity is certainly part of it, but there's a whole idea of redundancy of supply chains. And we see it firsthand at KKR because we've been forced to diversify our supply chains. And so one of the stories that's out there is, this is US. This is exports to the US, and the purple line it shows that China's way down, and it shows that Mexico's picking up. We recently sent people to Mexico. There are 300 manufacturers that are Chinese owned in Mexico. So what's happening is you can go to Vietnam and you can go to Mexico. Globalization is showing up in different forms. It's showing up in owning the land and owning the manufacturing, not just owning the trade. And so this is a much more complicated picture. But what it's leading to is corporates like KKR are having to spend to make sure that we can survive a power outage in Texas, a flood in California, cyber attack here. And so you're getting this spending that ultimately is something we're investing behind. And that is, the nature of CapEx is changing quite a bit.